Good morning viewers. Welcome to this session of teleconferencing. In this session, we are going to discuss about rational expectations. As you all may be aware, each one of us forms some expectations about future. We expect the increase or decrease in price level. We expect some growth in the economy. We expect some increase in our income level. We have certain expectations about everything, in fact, the policies, production, the production environment, in all spheres of life. So how do we expect? How do we form expectations? This is the topic that we are going to discuss today. Like, there are several spheres, in fact. There could be the yield of investment prices, the wage rates, the government policies, business environment, production technology. In all these things we form our expectations. These expectations could be for the short run or they could be for the long run. In the short run, it is very easy, it is relatively easy rather, I would say, to form some expectations. Like, for example, we can say with a fair degree of accuracy, with some predictions, with the development in science and technology, what is the weather condition tomorrow is likely to be. But it is very difficult to predict into the distant future. In the short run, we all may say that the prices are going to increase, the stock market is going to boom, or unless some unexpected things happen. So in the short run, it is relatively easier, it is relatively accurate to predict for the future. But in the long run, it is very difficult. And these long run expectations, how they are formed, on what basis, how accurate are they, for the theory behind that we are going to discuss today. The expectations has been there in theoretical aspects from the very beginning of macroeconomics, in fact. Like, if you look into the writings of Keynes, when he wrote the general theory in the 1930s, at that time itself he mentions about expectations. In expectations, like there is some expectations about some production decisions. Some producer, before taking some investment decisions, looks into what is he is going to expect, what is he going to gain out of that, what will be the price level, what will be the production level, what will be the market condition. So these sort of expectations has been recognized by Keynes also. In fact, he although assumed that the expectations are important, he assumed it away. He didn't pay much attention to expectations. He assumed that like when we are dealing with the short run, the expectations are given. So since Keynes was essentially interested in the short run analysis, he didn't look into the long run. So because of that, what he took is that the expectations are constant or given, or they remain unchanged over time. And on that basis he derived the marginal efficiency of capital, how much gain one is going to get from production decisions by some investment. So this is what expectations has been, how it has been visualized. Although it is recognized, it has not played any important role in Keynesian economics, in the writing of Keynes, I mean. But how do we form some expectations? How the expectations are formulated? How do we predict, or how the theoretically it can be developed? Let's look into that. In fact, these expectations are quite psychological in nature. How I expect about certain things, certain policies, certain behavior, these are all psychological. How I perceive things, it is very difficult to explain those things. Leave aside quantification. So these expectation formulations, or expectation formation rather, it is quite difficult, it is quite complex. It is not as simple as we predict on the basis of weather condition tomorrow. So what happens that many times these expectations go wrong also. We may expect something, but it may turn out to be wrong. It may not materialize. So how do we manage those situations? So what is essential in this case, suppose it would have been easier for us if there are some probability distribution available to us about expectations, about outcomes. Suppose, let me take one concrete example. Suppose I took one investment, I undertook, I built up a factory. in that factory I had some expectations that the prices are going to increase, the demand will be assured, the utility, the capacity will be utilized to the full extent, labor will be available, all raw material will be available. So this is under normal conditions what I expect, and I expect that I will get some profit out of the investment. But it may so happen that the government may impose some policy, some restriction may come up, in which case my entire expectations, whatever I had, may go totally opposite. Let me give another example. Suppose earlier this typewriting machine, they were very much prevalent, they were very much in demand. But with the invent of computer, the computer took place of these writing machines, these typing machines. As a result, the typing machines, they are not in that much demand. So if somebody started producing typing machine at that point of time, and computer comes into being, in that case the producer is definitely going to incur some losses. So what happens that the expectations that depends crucially upon certain conditions, the economic policy, the developments in science and technology, the psychological factors on the part of the customers or the clients. So the expectations are crucially dependent on these factors. But somehow, if suppose I know with some accuracy that what will be the outcome, what will be my output over a series of years. Suppose I undertake one investment today and I see that this is the output next year, the next to next year the certain amount is going to be increased or decreased. So I can say that with some probability, with some chances, with some accuracy, that these are the production level that is going to take place in the coming 10 or 15 years. So if I get some objective probability distribution about the output, then fairly I can predict about the future. But is it possible to get some probability distribution? These sort of probability distributions are virtually non-existent. It is very difficult. It is very difficult to get some probability distribution about the expectations. So what happens that how we undertake the expectations? Let's take a very simple example about tossing a coin. A fair coin is taken and we toss it for a number of times, let's say about 200 times. So what happens that we can consider the past experience of coin tosses. We can assume that the tossing of the coin is essentially under similar conditions. By essentially under similar conditions, what I mean that like the way you toss the coin, the height at which you keep the coin, the movement of your hand, the force with which you are throwing the coin. So all these conditions are remaining the same. Even the wind flow, the movement or the jerk that you give to your arm. So all these things remain similar. So if all these factors could be maintained at a similar level, at the same level, in that case it is like essentially it is called that it is tossed under essentially similar conditions. So it is possible maybe to toss a coin like under similar conditions for n number of times. N could be 200, 100 or any number of times. So but in actual events, are they similar? Are they like that? So when we are tossing a coin, in that case we say that it is possible to a fair degree of accuracy to maintain similarities in the conditions. So every event are performed under similar conditions. Okay. So in that case, when this is done, when we are tossing a coin under similar conditions, we expect that the relative frequencies of outcomes will stabilize. It is very likely that if the coin is fair, if it is not biased, in that case, like we may get 50% of head and 50% of tail. Okay. So this is how we form this data, that we are tossing suppose 200 times a coin and we are expecting 100 times head and 100 times tail. So this is the probability of head, that is half, and probability of tail is half. So this data, this like empirical analysis, empirical survey that we have, this forms the basis of our probability distribution in the case of tossing of a coin. So there could be many scientific examples, there could be many laboratory based conditions which can be formulated in this manner. Like in the laboratory you can maintain essentially similar conditions and you can perform several tests. But in real life, is it possible to maintain that similarity of conditions? Suppose when you are analyzing the behavior of a person, the person is behaving in a different manner every time. There is some randomness like associated with the behavior of the person. Every time suppose I go to the market, I may buy certain thing which I didn't plan, or I may not buy anything at all, although I went fully prepared to buy certain things to the market. And you can find numerous examples about these sort of conditions, these sort of like your plan and your expectation not being materialized, because there are certain conditions that you had planned. You probably before going to the market, I expected that the price of the commodity will be at such a level. The material that I am going to buy could be of certain color, would be of certain quality. But those things may not be available. Suppose when I go to the market, I see that it is very crowded, so I simply turn back without buying anything, which I didn't realize at all. So what happens that in real life situation, when we are encountering a particular situation, when you are taking a decision, at that point of time it is difficult to maintain the essentially similar condition. Suppose let's take the example of an investment project. In an investment project, what happens that certain information are available to us. We know from past behavior, those people who have undertaken investments, we know from their analysis, or maybe we have undertaken some similar investments in the past. So on that basis we have some bits and pieces of information. They could be the current yield on similar projects, they could be current trend in science and technology, or certain political developments. Okay, so what happens that when we take some decisions, in that case we take the bits and pieces of information which are available to us into consideration and we take a decision. But it is difficult that they cannot be taken repeatedly. It is difficult that the same condition, the similar condition should be maintained, and very likely that we will take a decision under dissimilar or different conditions. The market environment may be different, the investment atmosphere that may be behaving differently, the consumer behavior that could be different, the government policy could be different. Essentially there could be a feel-good factor that we find these days, that people will buy more of a good because their income rises, because everywhere there is a boom, so there is some prosperity and it will do good business. So this feel-good factor, which has nothing to do with the industry or the investment, that may operate. So similarly there can be a very gloomy situation also. If everyone suppose expects that tomorrow is going to be very bad, the stock market may crash, the prices may slump down, the profit may not come, the raw material may not be available, there could be resource scarcity. So if this is the feeling of everyone, in that case obviously the past trend will not hold good. So what I essentially try to say in very nutshell is that it is difficult to maintain the similar conditions in real life. Whenever I take an investment decision, every time I take an investment decision, it is very likely that it will be in a different condition. Certain parameter, certain variable will definitely be different from what it was previous time. Okay, so a major lacuna that we find that these expectations, whatever expectations that we are forming that cannot be quantified. It is difficult to form some objective probability distribution about expectations. Okay, so what happens that there is some element of arbitrariness and in expectation formation, and individual decision makers rely on conventions and practical norms. So when there is a lack of quantified information, in that case what I do as an investor, I may rely on norms, I may rely on some rule of thumb, I may rely on the customs and tradition, that if a particular situation comes up, in that case this is the thing, this is the decision, this is the policy that is approached. Okay, so this is how people form their expectations. The people form their expectations on the basis of some customs, traditions, past experience, and it is difficult to quantify. But what happens that the economists particularly, they have some debates, they have tried to formulate expectations, and some say that there is some rule of thumb in decision making, but some others say that it is very complex process, it is very complicated, and there are certain rules by through some modeling, through some theoretical formulation, some expectations mechanism can be designed. This is how the expectations formation come into being. So what we have discussed so far, we say that expectations has been recognized in the past since 1930s when Keynes wrote his book, but since Keynes dealt with the short-run situation only, he didn't deliberate upon expectations, he assumed it to be given and he switched over to analysis of other aspects. Later on, economists, they have analyzed expectations, and these expectations have become dependent upon some objective probability distribution of outcomes. Since this objective probability distribution is not existing, it is non-existent, in that case we look into some other things, some psychological factors, and it is highly debated. Some say that it is based on some rule of thumb, some say that it is a complex procedure, it is a complex mechanism. Generally there are three things that three types of expectations in fact are prevalent. One say that there is some static expectations, another say that it is adaptive expectations, and a third theory that has come up is rational expectations. We will discuss about all this theory in detail now. So this static expectations, what it is? This static expectations, in fact, it says that next year is going to be similar as this past year. Whatever condition was operating in this year, the same condition will go on, will continue. Suppose if I was doing good business this year, next year also I'll be doing good business. If my production of a particular factory is suppose is 100 quintal, next year also it is going to be 100 quintal. If I suppose got 35 customers in the past month, in the coming month also I will get 35 customers in my business. So what happens that this is some static expectations hypothesis. It doesn't have any dynamism, it doesn't have any change. So the basic limitation of this static expectations hypothesis is that it doesn't learn from the past. It assumes that the past is going to be repeated. So as a result, what happens that the static expectations is very often it goes wrong, because many things are dynamic in the world, things change, situations change, expectations definitely will change also. So how can we expect that the similar condition, the same condition is going to continue in the next period also? So this is a major limitation of static expectations, and not much work has been done on this basis. It is very elementary, very crude. What the remaining two expectations are, that is adaptive expectations and rational expectations, these are modeled extensively. Many theories have been built up, economists have done much work based on these adaptive expectations and rational expectations. Let's look into these two. Let's begin with adaptive expectations. In adaptive expectations, what happens that individuals update their expectations about future every year. It is different from static expectations. In adaptive expectations, individuals or decision makers, they could be consumers, they could be investors, they could be like many groups. So what happens, whoever are the economic agents, whoever are taking decisions, they realize that the future is going to be different from the past, but they accordingly they update their expectations, and this adjustment depends upon the extent of error committed in the past year. Let's take one example. Suppose in the year 2005 the inflation was suppose around 4%. In the year 2006, if I expect that the inflation is going to be at 5% only, and if I see that inflation actually has been 6%, not 5%, then I am wrong. I underestimated the rate of inflation, the rate of price increase. So what has actually happened, that whatever I expected 5%, but the actual is 6%. So what happens that my expectation has gone wrong. My expectation was underestimated. So in practice my expectation is somewhat lower. So while making some expectations, while forming some expectations about 2007, what I will do, I will expect a little bit higher. The difference between 6% and 5%. I expected 5% and it actually happened to be 6%. There is an error of 1%. So that error I will try to close down. So obviously I will not close down the entire difference of 1%, the entire error. What I will do, I will do a part of the error. Okay. So what I will do, I will partially adjust my forecast, my expectations about future in the next period. So as a result, what is happening? That in the process, over the years, I am updating my expectations. It is based on my past information, my past records, but still it is different from what it was in the past. And the adjustment that is taking place, that is on the basis of the error. It is not fully compensating for the error, because I am afraid that it may be a temporary change, it may be a very different shock, it may be a positive shock that the inflation increased up to 6% instead of 5%. So in forming expectations about the year 2007, what I will do, I will not take the expectation as 6%, I will expect it to be say 5.5%. So the difference between 5 and 6, that is 1%, I will add half of that. This is one example that I am taking. So in real life, what happens, that the error between the expected and the actual, that is taken into consideration, and on that basis, if it is partially modified, the part of the error, a fraction of the error, that is adjusted. This is the adaptive expectation hypothesis. So this adaptive expectation hypothesis has been utilized basically in two things, in fact, in permanent income hypothesis and in Phillips curve. But we are confining our discussion today to Phillips curve only. Let's take this example and try to distinguish between adaptive expectations and rational expectations. Let's begin with again the adaptive expectations we are continuing with. As I told, in adaptive expectations there is updating of the information, updating of the forecast, but it depends on the error, and part of the error is corrected. The full error that is not corrected in this mechanism. Okay. So as a result, what is happening? Before coming to this point, let's look into another implication of this adaptive expectations. In adaptive expectations, what is happening, that I am partially adjusting my forecast. There was an error of 1% in the inflation example that I took. I expected inflation to be 5% and it actually turned out to be 6%. There is an error of 1% in this case. So what I did in this case, that I adjusted it by 0.5, half of that. Suppose in the next year that inflation again is 6%. So I expected it to be 5.5%, but it turned out to be 6%. So there is an error of 0.5% again. So the next year what I will do, I will take half of the error again. So 0.5% is the error. So I take half of that, that is 0.25%. So for 2008 my expectation will be 5.75%. Okay. So in this way gradually I will move from 5% to 6%. So what is happening in this case? I am not taking any decisions, although I know that I am taking my past into account, past information into account, and I am making some changes which is like partial, which is the adjustment that I am making is not full. So as a result, what is happening, that my decision is moving or inching away, or it is tends to the equilibrium level. So as a result, it never reaches the equilibrium level, but it tends to asymptotically, you can say in probability or in statistical term, you can say that in as per the limit theory, that it limits or it tends towards the equilibrium level. So I may not reach the equilibrium level at all. I tend to, over a long horizon of time, in the long run I will reach the equilibrium level, but in the short run I am not taking into account the full information available to me. We will come to the limitations of the adaptive expectations again. So now let's look into the Phillips curve. We know that there is a some just give me. Yes, in adaptive expectations what is happening, that the individuals update their expectations, and in rational expectations we find that there is a mechanical model of expectations. These are very, in fact, crude, but individuals more sophisticated means than the adaptive expectations. In fact, they learn from future, they collect all information, and it is not possible for them to process their information or to make their forecast on the basis of past information also. They look into the future also. So in rational expectations, what we do, that we take into account all information available to us. We don't look just to the past data, and we do not make repeated errors. This is the rational expectations hypothesis. In rational expectations, in fact, there is a chance to make to take all information into account. Now let's look into the Phillips curve. As I was telling, the Phillips curve and the permanent income hypothesis, these are two models where these adaptive and rational expectations are used. So let's look into the Phillips curve, and in Phillips curve we see that it gives the inverse relationship between unemployment and inflation. This means that when inflation is high, unemployment is low. When inflation is low, unemployment is high. The government cannot achieve both the things in an economy. So in an economy, what is happening, that the inverse relationship is operating. There is a trade-off between these two, inflation and unemployment. And this inflation unemployment relationship, this inverse relationship, are stable. In fact, when A.W. Phillips invented, or rather gave us the Phillips curve for the British data during 1950s, after that it has been utilized for many countries, and during 1960s it was found to be stable for many countries. But with the advent of 1970s, there was a stagflation in the economy, And what happened? That at that time there was high inflation and negligible growth in the economy. The inflation was very high, unemployment again was high because the growth didn't take place. So high unemployment and high inflation, like they accompany each other, they are associated. This is somewhat different from the Phillips curve. What the Phillips curve tells us, that there is a inverted U, there is one U-shaped relationship between the inflation and unemployment, but this relationship didn't hold during the 1970s. This situation during 1970s is particularly called stagflation. So in stagflation, what happens that there is high unemployment, there is high inflation, there is very little negligible growth. So this inverse relationship between these two, the unemployment and inflation, that doesn't hold in a stagflation situation. So how do we analyze that situation? How did economists reacted to this sort of situation, this stagflation? Particularly Friedman, if we look into his analysis, in that case what happens that he tried to analyze the Phillips curve in terms of adaptive expectations, and he suggested that there is a natural unemployment rate in an economy. If the actual inflation rate is greater than the expected inflation rate, in that case what will happen? That inflation will rise in the next period. And if the actual inflation rate is less than expected inflation rate, in that case inflation will fall in the next period. There is some adjustment for some prediction error in that case. But what happens? That the unemployment in the long run is at a particular level. There is a vertical straight line, as you may be aware from your other blocks. It is a vertical straight line in the sense that there is no trade-off between unemployment and inflation. If in the long run unemployment is at a particular level at its natural rate of unemployment, and if suppose the unemployment in practice actually if it is higher than the natural rate, in that case there is increasing rate of deflation. That means in that case what happens? That the price level will decline further at an accelerating rate. So unemployment is associated with low rate of inflation. Okay. So if unemployment is higher, if people expect that the unemployment is going to increase further, in that case definitely the price level will come down. So there will be deflation. It may result in a deflation or price decrease in the economy. If on the other hand, if there is unemployment which is lower than the natural rate, suppose people expect, if there is expectations that unemployment is actually going to be lower than the natural rate, in that case the prices are going to be higher, because low level of unemployment is associated with high rate of inflation. So if it is lower than the natural rate of unemployment, in that case the inflation will increase, it will accelerate. This is the crux of the matter of adaptive expectations according to Friedman. So according to him, it is stable, the unemployment is stable only when it is at its natural rate. So if there is any deviation in the unemployment rate from its natural rate, if it is lower, in that case there is a rise in inflation which is accelerate at a very high level, it will explode, the prices will increase, there will be hyperinflation. If there is on the other hand a actual unemployment is higher than the natural unemployment, in that case there is going to be deflation, the price level will go down further and further over the time. So this is what we say. Let's look into the adaptive expectations again. Like if for a time period actual unemployment rate is less than natural unemployment rate, okay, in that case what is happening? That actual inflation is more than the expected inflation. Because we know that there is some inverse relationship between unemployment and inflation. So if actual unemployment is less, then actual inflation is more. Okay, so this is how the relationship stands. If the actual inflation is more than expected, in that case, in the next period, people will reformulate their expectations. They are going to modify that thing, and they say that there is a more of inflation. They will expect more inflation. But let's expect that there is a, let's assume that there is a constant rate of inflation. Suppose the prices increase at a fairly stable rate, there is no fluctuation in the price rate, and the the unemployment is less. If unemployment is less than the inflation, if unemployment is less than the natural rate of unemployment, in that case what is happening, that the actual inflation is high. If actual inflation is maintained at a particular level, in that case what happens, that there is a unemployment, but that will go on increasing. So what the adaptive expectation says, it says that there is at a particular constant inflation rate, it is possible to have a growing unemployment, but still which is lower than the natural rate of unemployment. That means there is some trade-off that is taking place in the case of adaptive expectations. Let's contrast this thing with the rational expectations. What happens when there is rational expectations? Suppose people take into account the future information, or the whatever information is available to them, whatever they collect, the bits and pieces, not only their past decisions, past errors, but they take into account like all information available to them. So in that case, how they will behave under this situation, let's look into that. What happens, that in rational expectations, as I mentioned, this is basically done by Robert Lucas. This is the work of Robert Lucas, and he says that there is a probability distribution of prediction. So if the prediction error, if some error is taking place, if that can be distributed in the form of a probability distribution, in that case we assume that individuals do not make systematic errors, and the sum of errors, that means positive errors and negative errors, they would be equal. If I go wrong, suppose if I underestimate inflation half the time, I may be overestimating inflation the remaining half time. So this is how the inflation and unemployment, they are related. That means if I predict that the inflation is going to be lower than expected rate, the actual rate, in that case I may go wrong half the time. The remaining half time I may be right. I may be committing some other type of mistake. So in this case, in rational expectations, what happens, that there is no trade-off, and this explains the stagflation situation in a much better manner. So let's look into the implications of the rational expectations. It says that there is no trade-off between inflation and unemployment. And secondly, that people anticipate everything. If suppose the government is going to change some policy, people anticipate it, that certain things have happened, certain other indicators have moved in a particular direction, so the policy or some countermeasures will be in a particular way. So people anticipate. So if people anticipate, in that case the policy becomes ineffective. Let's take the example of the stock market. Suppose everyone expects that the share market, the share prices is going to decline tomorrow. So what will be the immediate reaction? Obviously, I as an investor, I would like to dispose of my shares. I will go to the market and sell it. So if everyone starts doing that, if everybody starts selling their bonds and stocks, then the share market, share prices will decline. So if there is a popular psychology, if there is a psychological behavior, some perception, some expectations in the minds of people that certain thing is going to happen, that is very likely to happen. This is the group behavior that works. So if everyone expects that share price is going to decline tomorrow, in that case everybody will try to sell their shares and actually share price will decline. So that means in the case of the policies also, in the case of government policies also, if everybody expects that this is the way the government is going to react, the government is going to take certain decisions, so everybody will wait for that. Suppose if I expect tomorrow that the petrol price is going to decline, so I will not buy petrol today, I'll postpone my purchase, my demand for tomorrow, I'll buy it tomorrow. So if everyone starts doing that, in that case actually the demand is going to decline. So that is true of many cases. So what it says that under rational expectations the government policy becomes ineffective, because people anticipate things, people have their own expectations, they try to collect all information, and on that basis the whatever information, whatever expectations they formulate, that materializes, and the policy virtually becomes ineffective in rational expectations. So to wind up, let's summarize that there are basically three types of expectations. One is the static expectations, the other is adaptive expectations, and the third one is rational expectations. In static expectations, there is no change in the expectation from period to period. This is very unrealistic, very crude, not used in many models. Adaptive expectations has been used in certain cases. Adaptive expectation, it assumes that people change their or update their forecast or expectations on the basis of past errors. Whereas rational expectations assumes that people take into account every information available to them and they take decisions which is quite informed and they anticipate things. So in that case there is a inference drawn from on the basis of rational expectations that the policy may become ineffective. This is what we have to discuss today, and we hope that you will benefit from this lecture. We will continue with some other topic next time. Thank you.